It's time for the Property Podcast, where every week tens of thousands of property investors, new and experienced, join together to get news, knowledge and laughs at our expense. With me, Rob Bence.
And me, Rob Dix. Join us every Thursday morning for your weekly dose of property ideas and motivation. Then head over to our website at thepropertypodcast.com to keep the conversation going. Now though, let's get started.
Hello everyone and welcome to the Property Podcast. It is episode 98. Ooh, we're getting close to the big 100. It's Rob B. With me as always is Rob D, and our special series continues today.
Yeah, so this is part 2 in a little mini-series, How to Become a Property Investor. Last week, we talked about some of the things that you needed to get straight in your own head before you started. This week, we're talking about some of the really big concepts, and then we're going to wrap it up next week by getting into the nitty-gritty of exactly how you find and tenant your first investment property. So all that coming up, as well as the news story and resource that you've come to expect if you're a regular listener. And if you're new and someone sent you this and you're listening to this series as your first experience with the Property Podcast, welcome. It's good to have you here.
It certainly is. Welcome. Howdy. If this is your first one, you may want to go and listen back to part 1 because it kind of goes in order. This is part 2. You're not going to suddenly not make any sense of what we're talking about today, but if you want to go in order, feel free. But, you can crack on with part 2 if you want to. In part 1, you would have heard of a news story, and we cover news stories every week, and we were talking about property markets outside of the capital expected to do better. And in particular, one of the ones mentioned was Birmingham. So this week, Rob, the news story is a view inside. It's in the Birmingham Mail, so thank you, Birmingham Mail. A view inside the most expensive property in Birmingham. Are you a fan, Rob? Are you moving?
It does look very nice. I was going to say, if this is one of your first times listening to the Property Podcast, maybe go back and listen to previous news stories because they're normally a bit better than this one. It has been a bit of a slow news week. But yeah, 2.5 million for an 8-bedroom house in Birmingham. It does look very nice. I'm not going to be moving just yet. There is apparently a climate-controlled wine cellar, which is always a must. In the comments, the first comment is someone saying, "How boring is that garden?" So just going to show that even for 2.5 million, the most expensive house in Birmingham, and you can't keep everyone happy still.
If you'd like to have a nosy yourself, because I love looking at things like this, then go to the show notes. This week's show notes will have lots of useful content as well as this silly story. But if you want to check out all the serious notes as well as this one, then go to thepropertyhub.net/how to become a property investor. That's thepropertyhub.net/how to become a property investor. And not only will it give you the links from this week, but it'll give you links from part 1 and part 3 next week. They'll all be in the same place.
Yeah, exactly. So let's get talking about how to become a property investor then. So last week we covered some of the things that you need to be thinking about to discover whether property investment is right for you and understand some of the main issues around it. We talked about things like networking, building your team, forming a strategy. So to bridge between that and actually going out and finding that first investment, there are some concepts that you're going to need to understand that are absolutely pivotal to property investment that dictate what makes it such a great thing, the things that you need to be careful of, how you assess an investment. All of that stuff is tied up in these concepts. So that's what we're going to talk about in this week's episode. The first thing we're going to talk about is something that we touched on last week. We're just going to talk about it briefly again, which is capital growth and cash flow. Those are the two elements that you get in any property investment. You get the growth of the property over time, because as we know, property prices go up, and we're going to be talking about why they go up over the long term later on. But they go up in price. So if you hold a property for 10 or 20 years, you can expect that it's going to be worth more than you bought it for. So that's your capital growth. There's also the cash flow or the rental income component, which is the idea of you buy an investment, the tenant pays you rent, and by the time you've paid off your mortgage and all your other expenses, you're left with money left over each month. And you can then use that money to spend on yourself, to invest in your next property, or do whatever you want. So the great thing about property is that you get these two components. So if you've got your money in the bank, all you're going to get is some monthly interest. If you buy a classic painting to invest in, the value of that painting might go up over time, but it's not going to make you any money every month. With property, you get both. The important thing is making sure that you get the balance right between the two. Because we talked before about how the long-term wealth from property is in capital growth. The returns that you make from capital growth are going to dwarf your rental returns over time. However, you don't want to be in the position where you're buying a property because you think its value is going to go up over time, but it actually costs you money every month. It's very easy to buy a property where by the time you've paid off all your expenses, the rent isn't enough to actually cover those bills. And so you're having to subsidize it with your own money every month. That is not a position that you want to be in, because you're never going to get that long-term capital growth if you've been forced to sell the property or, in the extreme case, even go bankrupt because you couldn't afford to maintain it. It's important to understand why those two factors make property investment so beneficial, but it's important to get the balance right between the two. So everything that we're going to be talking about, we're going to be talking about leverage, we're going to be talking about property calculations and a few other things, and all of those tie into this to make sure that you can get that balance right and make sure you buy a property which gives you some nice capital growth over the long term and puts money in your pocket every month as well.
And this is just scratching the surface of that topic, and actually we're going to do a much, much bigger podcast on that subject alone because you can go into so much detail. But as long as you understand the core concepts, then you can start to move forward. But something else you need to understand before moving forward is leverage. When you pick up property investment books, the property podcast early on we talked about this, one of the first subjects they talk about, and rightly so, is leverage, because leverage is pretty much unique to property investment, but also massively, massively powerful as a tool to increase your wealth. Let me give you an example and demonstrate what leverage is, because leverage essentially is taking a little and doing a lot with it, or taking something a lot and making it huge. So let's have a look at how it would work. So let's say I had £100,000. I could take £100,000 and I could go and buy one property cash. Fantastic. So I've got one property, I collect my rent, and in it comes. No mortgage. Now, at some point, the property market will move up. And let's say over time, it's moved up by 25%. That property that I've bought cash is now worth £125,000 because it's gone up 25%. Fantastic. So my asset's gone up. I've been collecting rent. So I've been paid to own an asset that's gone up over time. Fantastic. However, by using leverage, we can accelerate that wealth effect. And this is how. Let's say we didn't use that 100,000 on one property, but we split that 100,000 into 4 25k deposits. And we put £25,000 down on the property, and we had a £75,000 mortgage. So 25 down, £75,000 mortgage. That means that we can do that 4 times because we've got 4 25s. So now we've got a property portfolio worth in total 400,000 with mortgages of 300,000. When the market goes up 25%, like in our last example, that property portfolio now is not worth an extra 25k. It's worth 4 25ks because we've got 4 properties. So it's a 100k profit. So actually, we started with 100k in the first example and made 25k profit. So a 25% return. But in the second example, we've put no more of our own funds in, but we've managed to take that return from 25k to 100k. So against the 100k we've put in, that's a 100% return. So no more of our own money, but we've vastly increased our wealth. That's why leverage is so important. And we've done a podcast on this. If you'd like to listen to a whole podcast on this subject, then go to the show notes, thepropertyhub.net/how to become a property investor, and you can listen to that episode.
Yeah, so leverage makes a big difference to the results that you get over time. It also makes a big difference to how hard your money works for you in the short term. And that ties into the concept of return on investment, which is something that we're going to talk about as well. Because there's a few different ways that people calculate the returns that they get from a property. There's gross yield, there's net yield, and there's ROI, return on investment. So gross yield is a figure that you see thrown around a lot because it's the one that looks impressive. So you calculate gross yield by taking the rental income that you get from a property over a year, dividing it by the purchase price, and that gives you the gross yield. And often it looks like sort of quite an impressive number. So you might get a gross yield of 7%, 9% and think, brilliant, compare that to my cash in the bank, which is getting nothing. That's a great return. However, gross yield is not a lot of use because it doesn't take into account any of the expenses. So that's where net yield is more useful, because this is where you take the income that you get from rent, deduct all the expenses that you have to pay, such as your mortgage payments, what you're paying your agent, repairs, an allowance for voids and all that kind of thing, and then you divide that by the cost of the property. that gives you a net yield number which looks a lot less exciting. So by the time you've deducted all these costs, you might find that your yield is only sort of 1 or 2, 3%. And then you'll compare that to what you could get in the bank or in some kind of long-term ISA or something and think, well, why should I bother going to all this effort of owning a property if I'm only going to end up doing a little bit better than I could in cash? And that is where leverage comes in. Because if you use leverage, then you're not having to put in the full purchase cost of the property yourself. You might only be putting in 25% of that. So return on investment is calculated by taking the profit that's left over when you take the rent and deduct all the expenses and divide that by the cash that you've put in yourself. And that number starts to look a lot more impressive again. So by using leverage, as well as making you more money in the long term because you're getting more upside from the capital growth, you're also getting a far better return on investment than you could do relative to other investments in the short term. So ROI is not only one of the more encouraging numbers to look at, it's also the most useful because it's the one that takes into account all the information. So if you're realistic about your costs, you know what your costs are going to be, and you know how much money you're putting in, then you get an ROI number which is realistic, which you can use for two purposes. You can use it to compare against other investment classes that you could be putting your money into to see how hard your money's working. And you can also use it to compare across different types of property you could invest in. So you'll get some properties, such as HMOs, which I'm sure we'll talk about a little bit in the future, which can have a really impressive gross yield, but then by the time you take out all the expenses, the actual ROI might end up not looking that spectacular. So you can compare that to another property, which might apparently have a lower gross yield, but then the costs are lower, so the ROI might end up being the same. So it's useful to compare across investment classes and between different property investments you can make as well. It's not easy to understand those calculations necessarily when someone's just reading them out at you. But if you go to the show notes, we'll have a quick explanation of them and we'll link to a couple of resources for you as well. So you can study those a little bit more if it wasn't clear straight away. But those are really important concepts that directly tie into leverage.
Make sure you yield that advice. Oh, right. Next, inflation. Inflation. Important. Sounds boring, but incredibly important. Inflation has a massive impact on property investors who invest for the long term. And for most people, that's what you should be doing, investing for the long term if you take on property investment. So first of all, it's important to understand what inflation is. So let me give you an example. Let's say I had 20 pence and I jumped in my time machine, which is currently broken. But if it was fixed, I'd jump in my time machine and went back 20 years. I could walk into a shop with my 20 pence and buy a pint of milk. However, if I then got that 20 pence and decided not to buy it 20 years ago, fast forwarded to today, went to the same shop, I take that 20 pence in and go to buy a pint of milk again, I can't. The milk is still the milk. My 20 pence is physically the same coin, but the value of my money has decreased. And that's inflation, the price of goods going up, but really it's your money being worth less. So my 20 pence is worth less than it was, so therefore I can't buy the milk anymore. But the same thing happens with debt. Let's say that I had a buy-to-let mortgage on a property 20 years ago, and I go back in my time machine and I buy a property in London, central London, and I have a £20,000 mortgage on it. Now, 20 years ago, that may have felt like a big mortgage. Wow, £20,000 mortgage. And let's say in 20 years' time, I haven't paid that mortgage down. It's still £20,000. But if you fast forward 20 years to today, then actually a £20,000 mortgage on London is low. It's actually, I'd love a £20,000 mortgage on a property in London. 20 years ago, it felt like a lot. But today, it's hardly anything. So the number's the same, but what's happened is inflation has eroded the real value of the debt. So over time, if you take out a mortgage today, and let's say your mortgage is £150,000, you think, oh gosh, £150,000 mortgage. Fast forward 20 years ahead, a £150,000 mortgage will not feel like nearly as much. So the number remains the same, but the value diminishes. And that's why for property investors who invest over the long term are rewarded by inflation. So not only can we take advantage of leverage, but we can also take advantage of inflation. There's so many tools property investors can use. So leverage is talked about a lot. Inflation, not so much, but it should be because it's just as important.
Yeah, and we did a whole episode on inflation, which we'll link to in the show notes as well. Well worth a listen. And the upshot of that was that inflation happens broadly over the long term, and that can be a good thing or it can be a bad thing depending on which side of the equation you're on. And as a property investor who's got debt, inflation, within reason, is a good thing for you. It erodes the value of your debt and is just another reason why leverage is such a powerful thing. But we've been talking about leverage a lot, but what form does that leverage take? Well, for most of us, it's going to be a buy-to-let mortgage. It's important to understand what a buy-to-let mortgage is and how it's distinct from a residential mortgage, which you might have had before. So the first thing to note is that a buy-to-let mortgage is based on the rental income that the property generates rather than your income. Lenders are going to have different criteria that they'll accept in someone who wants to borrow money from them. They tend to vary. Some of them are more strict than others. They're mostly going to want you to have some kind of income, and they're going to want you to be creditworthy and not have too much adverse credit. But what they're really interested in is the rental income that the property can generate. Because ultimately, if you default on your payments, they'll repossess the property and they want to know that they can make a profit of it until they have to sell it. And they also want to know that you can afford the repayments. Normally, they will lend you 75% of the property's value. 75% loan to value is kind of the norm. You can get up to 80. Depending on when you're listening to this, the mortgage market might have changed. It might have got a bit more lenient. You might be able to get beyond 80%. But as you get higher, the rates tend to go up. So the interest rate that you have to pay is going to get higher. If you're only wanting to borrow, say, 60% of the property's value, then you can get better interest rates in general and lower fees. However much you borrow, buy-to-let mortgages tend to be on an interest-only basis. And that means that every month you just pay off the interest that is due on your loan. So say you borrow £100,000 at an interest rate of 5%. That means that you have to pay back £5,000 a year. That means that every month you pay back about £420, which is a twelfth of that £5,000. That, of course, means that when you get to the end of the mortgage term, you still owe exactly as much money as you did in the first place. So that £100,000 loan, you're still going to owe £100,000 at the end. That might sound scary, but as Rob's already talked about, that £100,000 in 20 years or 25 years when your mortgage term ends is not going to be as big of a figure as it is now in real terms. Now, that's different from a repayment mortgage, which is where the kind of thing that you'd have on your house, where every month, as well as paying off the interest, you'd also pay off a portion of the amount you borrowed. So at the end, you own the property outright. You can do that, but investors tend not to. And there are several reasons for that. One important reason is that it improves your cash flow, something very important that we've talked about. You want to make sure that your property isn't costing you money every month. It needs to be putting money in your pocket every month. Also, it's more tax efficient, which is something we won't get into now. And also, it's because of this inflation effect. So you don't have to be on an interest-only mortgage, but it's what the vast majority of investors tend to do. People tend to debate this. People have strong views about it, but we both use interest-only mortgages, and I'd say that the majority of investors do as well. The only other thing to say about mortgages for now is that it's always well worth using a mortgage broker. Because while you can go and get a mortgage yourself, you can just go onto a comparison site, you can walk into a bank. It's highly unlikely that you're going to be able to get the best product for you because there's more to it than just the interest rate. There's all kinds of fees, there's all kinds of conditions. You could figure it all out yourself, but it's going to take a very long time. And even then, it's unlikely that you'll be able to come up with what a broker could do for you in 10 minutes. Because mortgages are determined not just by the interest rate, but by the fees, by the criteria, all kinds of things. So using a broker is definitely worthwhile. If you're in the Property Hub, you'll find a few of them. You'll be able to get recommendations from other people as well. Definitely use a broker to get your mortgage right because we've talked about what an important part of the overall investment picture a mortgage is. So you want to get it right.
You certainly do. Right. Something else you want to get right is your understanding of property prices and in particular why they rise. You're investing in property because you've seen property prices go up. I'm sure you've seen other people make money from property prices go up. And everyone tells you property prices go up over the long term. So that's fantastic. But you shouldn't just go forward because everyone says property prices rise. You need to understand why. And there is a very big reason. There's multiple reasons, but there's one overriding factor that makes property prices go up over time more than anything else. And that is supply and demand. So let's go back, a history lesson first of all. If we go back to 1952, that's when the first price index was formed. And the price index is just a recording of property prices. So property prices were first officially recorded on a regular basis from 1952. And that was the nationwide price index. If we go from 1952, fast forward all the way to today, then we can see, on average, UK property prices have doubled every 9 years. Sometimes longer, as long as 14 years, and sometimes short, as quick as 3 years. But the average is 9. That's quite impressive. Most people think, wow, 9 years, property prices double. The reason why is supply and demand. Supply and demand. The amount of people who need and want property outstrip the amount of property available. If we go back just over 10 years, we can see the government produced a report, and that was called the Barker Report. And one of the things it looked into, amongst others, was the housing crisis, and in particular, how to solve it. And the Barker Report stated just over 10 years ago that in the UK, to keep level with demand, that we need to build 250,000 250,000 new homes each year to keep level. So that's not to reduce the demand, that's to keep level. And that was 10 years ago. Now, since that report was published, how many times have we hit that target at 250? 5? Less? 3? No, 0. Not once. To give you an understanding, the property market's been quite good over the last 12 months. We built less than half of that, just over 100,000 homes in the last 12 months. But what's happening with demand? Well, our population in the last 12 months grew by 500,000. So built 100,000 homes, but the population grew by 500,000. And that's a combination of things, of people living longer, immigration, and so on. There's lots of different factors, but this isn't a recent trend. As I stated, this has been happening since 1952. So people are talking about it a lot now, but this has been happening for 60 plus years. And it hasn't been solved at any point. And that's the point. There doesn't seem to be a way to solve this problem. Because while we all agree we should build more homes, nobody wants it near them. You know, if you live in a semi-rural area, you probably know that, there's planning permission there for a new housing estate, but we're going to rebel against that. We don't want it. Not in our backyard. NIMBYs, not in our backyard, they're called. People don't want property built near them, but they want more properties in general. And that, unfortunately, means that because of this, and it's never going to change, our strict planning laws, we are always going to have this deficit. And while we have this deficit, we will always have property and prices increasing over the long term. Yes, there are short-term fluctuations where they come down for a bit, but they recover upwards. The graphs show that. The property prices are actually quite predictable. They're a wave, but they're a wave upwards.
Okay, so let's start wrapping this up for this week, and part 3 is still to come next week. So let's finish by talking a little bit about risk versus reward when it comes to property investment, because the rewards are very exciting. We've talked about that. We've talked about how you make money every month and then you get capital growth over the long term. But then there's risk involved as well, as there always is. And like any other type of investment, in property, getting more reward involves taking on more risk. And there are certain types of property investment that seem very glamorous to newbies, but they do come with a high degree of risk, so you need to know what you're getting into. So to take a couple of examples, take flipping. So buying a property, doing up, selling it on. Very glamorous, very exciting, but very risky if you don't know what you're doing, which when you're starting out, there's going to be a lot that you don't know if you're not an expert in that kind of area. Take HMOs, houses in multiple occupations, so a property that's rented out by room. They can have big rewards if you get the numbers right, but they can also be very risky because of the financing position, the licensing position, potential conflicts among tenants, management, all kinds of extra risks in there that you don't get with a normal buy-to-let. These are all things that seem very attractive to start with when you just look at the reward side of the equation, but you've got to consider the risk as well. And to start out, you might not want to be going after the very biggest rewards unless you're going to dedicate a huge amount of your time into mitigating the risk and doing all the learning, the networking, everything you need to do to mitigate that risk and make sure that you get it right. To start with, it's probably generally a good idea to just go for a kind of a vanilla buy-to-let. Because there's so much to learn and it's such a scary experience because the sums of money are so big, even when you're just buying a pretty normal buy-to-let property, so like a 2-bedroom flat or something like that. That's probably the best thing to start with if you don't have the time and the energy to devote into really getting deeper into something bigger. But even if you do that, of course, there is still going to be a risk. There's always going to be a risk to any kind of investment, any kind of property investment. If you wait for an investment with no risk, then you're going to be waiting forever. Because of inflation, doing nothing is the most dangerous thing you can do. If you do nothing at all, then you can be sure that your money will lose its value over the long term. There's always going to be risk. The important thing is to identify those sources of risk, mitigate those risks as best you can, but also accept that there's going to be some degree of risk and act anyway. And acting anyway is what we're going to be talking about next week when we actually start getting into the nitty-gritty of tracking down your first investment.
Okay, so a wealth of information there. And remember, go to the show notes to go to some of these links we've been talking about, because if you haven't been taking notes, you should maybe go back and listen to this. But also, as part of your research or education, go to thepropertyhub.net/how to become a property investor and start investigating some of the other links we've talked about as well. These 3 parts, these 3 episodes that we're doing on how to become a property investor are just the beginning of your journey. And if you're an experienced property investor and you're listening to this, then please pass it on to people you know. Pass that link that we've mentioned. The links to these podcasts will be there, but also all the links we mentioned too. So, it's time for our resource of the week. And this comes from Silvio's. Hi, Silvio. Thank you very much for sending this through. Rob, you sent it through to yourself. I've had a peek at it, or should I say a glimpse. But do you want to go into further detail?
Yes. So this is an app called Glimpse. What a coincidence, eh? Spelled GLYMPSE. They'll link to it in the show notes. And it's an app which is available for all major platforms like iPhone and Android. And what it does is it allows you to share your location with any contacts you want. So why might you want to do that? So there's a few reasons. First of all, if you're meeting someone somewhere, you can just share your location with them, and so they can see where you are. You could also let someone know where you are, so if you're running late for something, they don't have to hang around waiting for you because they can see how far away you are. Or you could use it for safety reasons as well. So if your kids or your partner are out and you want to know where they are and not have to worry about them, you can see their location on there as well. So it's really easy to use, and it means that you don't have to share your location with the world at large. You can share exactly who you want to give access to. As we were talking about earlier, Rob, kids of today are screwed. It's going to be impossible to lie about where you are. This is probably the biggest implication of this.
It certainly is. All those times telling your parents that you're at a sleepover and maybe somewhere where you shouldn't be. I'm not going to name any stories because obviously I was a model youth. Are now over. You've got no chance. But as we said before we went live, Rob, this could turn into app warfare.
Yeah, exactly. So I'm going to start work on an app for kids, which is going to place automatically generated calls from someone else's dad saying you're at their house, or from the school saying you're working late, or something like that. It's going to be the future, I'm telling you. But before we get into all that, we should move swiftly on, I think, to the iTunes reviews.
We should, and it's an absolute barnstormer of a review. Thank you, Ammo. We both know Ammo, and Ammo has put, over the past few weeks, I've listened to every single one of the property podcasts. I can honestly say that this podcast has saved me months, if not years, of research. Every single one of my original ideas to build a property portfolio has now completely changed. No doubt I would have come to the same conclusion eventually, but this has allowed me to save my most valuable asset I have, that is time. Although my goal strategy is still a bit fuzzy, it's a lot clearer than it was a few weeks ago, and I have Rob and Rob to thank for that. I started from the very first episode and worked my way through to the latest episode, and I know I've only been listening a few weeks. I now feel I've been on a journey with Rob and Rob from the very beginning. I love their openness, honesty, and willing to share their secrets with anyone willing to listen. If you're new to this and you're wondering if the podcast is for you, then I can definitely say yes. I thank you both from the bottom of my heart and hope I can somehow repay you with the favour to you both. Good luck with all your endeavours, Ammo. Wow, what a review. Thank you so much, Ammo. That's awesome.
Yeah, reviews don't get much better than that. Thank you so much. We've had over 250 reviews now. We appreciate every single one of them. We're going to read them all out on the show. So if you have left us a review, or if you're planning to do so in the future, thank you so much. So that is about it for this week. Join us again next week for part 3, where we're wrapping up this little series, How to Be a Property Investor. We're going to be taking these concepts we've talked about, which are great, but they're a bit abstract and they're only any use when you start applying them. So we're going to talk about exactly how to apply those next week.
We are. We're going to take you on a journey on how to invest in your first property investment. So now you know all the theory. Next week, as Rob said, it's action time. But until then, thank you so much for listening. Remember, the episode show notes are thepropertyhub.net/how to become a property investor. Get all the info and the links there. But until next week, everyone, bye-bye.
Bye-bye. Thanks for listening to The Property Podcast. Make sure you join our mailing list at thepropertypodcast.com.
And remember, we love 5-star reviews. Rob even loves the more than air miles.